Good morning. Today we start the session, and I just want to tell you the particular things which we are going to discuss today. I think we have now done the required subject areas, and therefore I think that it is better to just discuss the past question papers from today. So I will do the things today. I will do the past paper question discussions today, and the papers are downloaded, and we can just go through the papers and see what type of questions are there. And I just give you a brief explanations on how to answer those questions. So that is the plan of lessons today. So we will just see, and I think you all can actively join with that. And if you have any issues, you can just let me know during the session. And I think this is a very important type of discussion we are going to have, because it will give you a certain practical experience in answering questions, and you might get the very important principles where you have to follow when you answer questions. Right. I will start with the 2019 question paper. This is 2018 and 2019. Anyway, can have it. Right. Now we will just go through the question paper, and you can just see how the structure is in the question paper. You have 3 hours to answer this question paper and 15 minutes to read. There's a reading time of 15 minutes, and the paper consists of 7 questions, and you need to answer only 5 questions. So each question carries 20 marks. Right. Now we can start with question number 1. Now it contains 4 short questions, 5 short questions, and each part carries 4 marks. Right. Now what I want to tell you is, now when we discuss these things, you might come across the areas which we have already discussed, but there are several practical aspects and several other problematic type of aspects given in these questions. So therefore, you need to just apply what you have learned here. Right. We will go to the question number 1. Part A. A bond selling at a market price that is deeply discounted from its face value is more inclined to have a long time. Now, the question really requires, it says, give your comments on the following statements with a brief justification. Now, when you say comments, it can be, you have to say whether the statement is true or false, and then give the detail, give the justification. That is what you need to do. A bond selling at a market price that is deeply discounted from its face value is more inclined to have a long time until it reaches maturity, rather than a short time until it matures, because short-term bonds issued by healthy firms cannot sell for deeply discounted prices. Now just read that. A bond selling at a market price that is deeply discounted from its face value is more inclined to have a long time until it reaches maturity, rather than a short time until it matures, because short-term bonds issued by healthy firms cannot sell for deeply discounted prices. Yes. Now we need to really get some idea about it. So what is your whether, now first of all you need to think whether the statement is correct or wrong. That is the first thing. Yes. Shall we look at it? So it says, now a bond selling at a market price that is deeply discounted from its face value. That means the price, market price is lower than the face value. Now that is what you call deeply discounted. So what does that mean? Now if it is too low than the face value, now inclined to have a long time until it reaches maturity, rather than a short time, because it matures, because short-term bonds issued by healthy firms cannot sell for deeply discounted prices. Now, it's a type of a thing where highly discounted means the firm is not that healthy. So therefore, this particular statement is correct as it is. So anyway, now I just want to get your responses for this, and the second one. Anyway, I will just wait for your responses for a period of time. Then I will just come back to you. Then as a bonds, this is the second one. As a bonds YTM increases, if other things are held constant, its duration decreases. C, the valuation placed on a stock with the one-stage model depends upon the investor's expected holding period. D, a 50 asset portfolio, the portfolio contains 50 assets, has 1225 unique covariance terms. The internal rate of return is another term for the geometric mean rate of return. Now these are the short questions you have. So you need to give a comment whether it is true or false, and then some justification for your answer. So this is the questions requirement. Anyway, We'll see. Yes. Now you just go through it and just give your comments on that and give the justification also. Now that is the nature of the question number 1. Now you all can expect that type of a question in your question paper as the question number 1. Yes. This discussion would be very much important for you because you can just get an idea about how you have to answer the questions and the required details. Right. I will go back to the question paper. Right. The first part of the question, a bond selling at a market price that is deeply discounted from its face value is more inclined to have a long time until it reaches maturity rather than a short time until it matures, because short-term bonds issued by healthy firms cannot sell for deeply discounted prices. Now, it says more inclined to have. More inclined to have means there's a big chance of having a long time. So that is the question, the form of the question. So therefore, the answer for the first part is, you can say the statement gives a correct aspect of the situation. So then you can have a justification where you can say, when the price is so discounted, that means the YTM is very high. Now, YTM is the rate of interest. Rate of interest is higher for a say risky type of so that is the justification for this question part A. Right, now we will go to the part B. As a bonds YTM increases, if other things are held constant, its duration decreases. So this is also another type of question which you need some analytical thinking. So how you can just get this thing, justified? First of all, you need to see whether this statement is correct or wrong. YTM is the yield to maturity. So when you do the duration calculations, what you do normally, you just get the cash flows, and you have to get the weightage of the cash flows multiplied with the time. So that is what you do. So now when we do these weightages, what you do, you get the values and even the cash flows. The cash flows really depends on the YTMs. When the YTM increases, it depends on the coupon rate, but when YTM increases, the cash flow comes down. So therefore, when the YTM increases, the duration decreases. Duration decreases. So that is the correct form. That is the correct form. So then you can say, when the YTM increases, what really happens? the cash flows uh, will get decreased. So therefore, with that, what happens is when the cash flows decreases, and when it is weighted, the weighted cash flows also will decrease. So therefore, the value of the duration would decrease. So that is the correct justification for that. Right. Then we will go to the part C. The valuation placed on a stock with the one-stage model depends upon the investor's expected holding period. The valuation placed on a stock with the one-stage model. Now, you can just get remind of the one-stage model. No, as per the one-stage model, you all know what is the one-stage model equation. So the price can be given as price is equal to D1 divided by K minus D. K minus D. Now, when you look at that relationship or the model, when you say one-stage model, the one-stage model gives the value for the stock. So that value is given by a certain mathematical expression where you call it P0 equals D1 divided by K minus D. What do you mean by D1? D1 is D0 into 1 plus D. So that is the one-stage model. Now, just look at the statement. The valuation placed on a stock with the one-stage model depends upon the investor's expected holding period. So we need to see whether this particular statement makes sense. Now, is there anything to do with the holding period? So therefore, the particular statement is wrong. Why it is wrong? The one-stage model really assumes the particular holding period would be infinite. So therefore, investors' expected holding period will not have a bearing on that. So that is the justification. The valuation placed on a stock with the one-stage model depends upon the investor's expected holding period. I will show it to you this way. I will just put the formula. Right. Now just look at this formula. This is with reference to the part C of the question. P0 is equal to D1 divided by K minus D. Now D1 means D0 into 1 plus D. Now you can just see what are the types of parameters involved here. So D0 is the current dividend. G is the dividend growth rate. K is the rate of return. So do you think you have any type of layering of the investors holding period into the price? So if you look at this formula, you just can imagine there's no connection with the holding period here. So therefore the statement is wrong. Statement is wrong. I think you got this formula. Now this is a formula where you have to remember. You have to remember. So this formula is a very simple one. So I think if you remember it in this form, that would be easier for you. D1 divided by K minus D. D1 is the year 1 dividends, but it comes in this form, D0 into 1 plus D. If it is the growth rate, D is the growth rate. So that is how the formula is constructed. Then I think the part C is quite clear. Now, when you say a 50 asset portfolio has 1,225 unique covariance terms, this is also a type of analytical question. Now, this refers to the portfolio variance equation. Now, when you have a 2 asset portfolio, then you can have the variance in one type of formula. The portfolio variance is equal to, you put it in this form. If the portfolio variance is sigma p squared, it is equal to W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus 2 W1 W2 sigma 1 sigma 2 rho 1 2. So this is the formula. Now when you say sigma 1 sigma 2 rho 1 2, that is the covariance. So then in a 2 asset portfolio, you have one covariance term. In a 2 asset portfolio, you have one covariance term. So that is how we can just get it. So there will be a certain formula for that. Now, if you have 2 assets, you have only one covariance term. Then when you have three assets, how many covariance terms you have? Now say it is ABC. You have AB, BC, CA. AB, BC, CA. So there are 3 covariance terms for 3 asset portfolio. If you have 4 assets, then say the assets are A, B, C, and D. Then you have AB, BC, CD, DA. then AC. So these are how many of them now? Right. Now this one, I can just show you the way of getting this answer. There is the formula for this. Now, when you say two asset portfolio, say the assets are number one and asset number 1 and 2. So you all know the portfolio variance is given by sigma 1 squared W1 squared plus sigma 2 squared W2 squared plus 2 W1 W2 covariance 1 2. So that is the way it is to be calculated. So covariance 1 2 is the covariance term there. So therefore, when you have two assets, you have only one covariance term. But when you have three assets, you can just see how many covariance terms you get. Now, there the formula will be W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus W3 squared sigma 3 squared plus 2 W1 W2 covariance 1 2. 2 W2 W3 covariance 2 3. 2 W1 W3 covariance 1 3. So how many covariance terms are there? 3 covariance terms. When you have 3 assets, you will have 3 covariance terms. So this is a very easy type of a analytical question. And if you know the formula for this covariance, number of covariance terms, the formula is given by n into n minus 1 divided by 2. n into n minus 1 divided by 2. N is the number of assets in the portfolio. Now, when you apply that formula to the 3-asset portfolio, you can apply the formula. So in the formula, you have n into n minus 1. So n is 3, n minus 1 is 2, then 3 into 2 divided by 2 would come as 3. So therefore, for 3-asset portfolio, you will have 3 covariance terms. If you take 2-asset portfolio, there also you can check the formula. So when it has two assets, then n equals to 2. 2 into n is 2, then n minus 1 is 1 divided by 2. Then only one covariance term. Now you see the point. So this is a type of a question which stands on this formula. So therefore, now you can just calculate it for the 50 assets. Then it is valued at 15 to 49 divided by 2. 15 to 49 divided by 2 is 25 into 49. 25 into 49 is 1225. So therefore, this statement is correct. Now just see it. Right. Now the meaning of covariance terms is the number of terms you have. Now say if the assets are 1 and 2, so 1, 2 is a covariance term. When you have 1, 2, 3, then you have 1, 2, 2, 3 and 1, 3. So those are the covariance terms. I suppose that you got what I said. If you have any questions or any issues, let me know. Yes. Now, anyway, the question is when you have, the question says 50 asset portfolio has 1225 covariance terms. That is the statement. Now we have to see whether that statement is correct or not. Now I have just given you the way it can be done. Now first of all, you need to understand what is the meaning of covariance term. Now that comes with the formula for the portfolio variance. Can you remember we did that in one of our lessons? I think it is in the lesson 4 or lesson 5 or lesson 4. So we did that, the covariance. At the very beginning also we talked on those things. The variance of a portfolio is equal to the variance of each asset squared plus the covariance terms. So that is how it is been explained. So I have just given here the on the board, I have given the 2 asset portfolios variance W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus 2 W1 W2 covariance 1 2. Now this is the variance value for a 2 asset portfolio, and in this particular statement you have only one covariance term, that is 2W1 W2 covariance 1 2. That is the covariance term. So for a 2 asset portfolio you have one covariance term. Now if you put it for 3 assets, this is the formula for 3 asset portfolios variance, portfolio variance. W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus W3 squared sigma 3 squared plus 2 W1 W2 covariance 1 2 2W2, W3 covariance 2,3, 2W1, W3 covariance 1,3. So in the 3 asset portfolio variance formula, you will get how many covariance terms? 1, 2, 3. 3 covariance terms. If you look at 4 asset portfolio, you will get 6 covariance terms. 6 covariance terms. So therefore, in a practical situation, in a bank also, you might get hundreds of assets in one portfolio. Then you have to check how many covariance terms will be there. For that, you have a formula. So the formula is given here, n into n minus 1 divided by 2. That is the formula. So what we need to do is, you by heart or you can remember the formula, and if you know the number of assets, you can apply the number of assets as n. So here, the number of assets given is 50. We can check that here. So 50, n is 50, then n minus 1 is 49. Then you will get a number like this. 50 into 49 divided by 2. Then you get 25 into 49. 25 into 49 is 1225. So therefore, the statement given is correct. So when you answer that question, part C, you can say the number given in the statement is correct, because when you apply the formula, you will get the same figure. I think that is a fair level of explanation. So what I feel is that, yes. Right. Now, this is the part C. Part B also. Yes. Actually, when I started things, I thought that people were not there anyway. Now you have come. So I'm happy that you all engage in this. Anyway, I will go to the part B also, for some person asked me to do that again. Anyway, just see. Yes. As a bonds YTM increases, if other things are held constant, its duration decreases. So whether it is correct or wrong. So now here what happens is YTM. Now when you have the YTM, what will happen? Your discounted cash flows will be, now if the YTM is getting increased, what will happen to the discounted cash flows? It would go down in value. Because when you discount at the rate of YTM. When YTM increases, the discount comes down. The value comes down. So what happens then? The value into something, value into the time divided by the total value will give you the duration. So therefore, when the value decreases that way, the duration decreases. So that is how we explain that. Right. I think that that gives a correct explanation. So I really did see also. I think I just put the formula for that. That is also understood. Right. Then we go to the last one. Last part. The internal rate of return is another name for the geometric mean rate of return. I think this is a very, very straightforward and very easy question. What do you say? Is it correct or wrong? Now I just expect your answer for the last one. last part, part E. Very easy one. It's a very easy one. The last part, geometric mean return and the internal rate of return. Could they be the same or something else? But when you say internal rate of return, that is for a the particular discounted rate which equates the cash inflows and cash outflows, present value of cash inflows and cash outflows. So that is what you call the internal rate of return. But GMR is not that. Geometric mean rate of return. So we just did the calculation last time. So therefore, the statement is wrong. GMR is the geometric mean return of the returns. But internal rate of return is something else. That gives the discounted rate which equates the cash inflows and present value of cash inflows and cash outflows. So that is the internal rate of return. So therefore, this statement is wrong. Right. I think in order to get the full marks for this, you will have to say whether the statement is correct or wrong. Not only that, you have to give why you say that. So with that, you might get the full marks for that. So each part carries 4 marks. And I think this is rather easy question because you don't need to do so much of work here. Just to write something, write as one sentence as a comment. And whether put it as correct or wrong, that's all. So then I think a rather easy question, this question. But I have seen in question when I evaluated the question papers, I saw in most times people have written correct or wrong, but they are not given the comments as it is. So therefore, they didn't get the full marks for that. That was the issue. Because I can remember I marked question papers for the last couple of years. Then the same thing I experienced for all these years. So this time I think I can see a change with necessary comments given and getting the full marks. Anything else you need to do on that? Anything else to or any clarifications on the answers? Right. We'll go to the question number 2. Right. Now the question number 2. It shows some data points where you can see the state of economy, probability, return on xenon, return on Yaris. Now it says the xenon and the Yaris corporations have the above joint probability distribution on their expected returns. Now, when you have this type of information schedule, now you need to design a worksheet. You need to design a worksheet. Now, you all know when you want to calculate the expected value, what shall we do? Now, you have different state of economies. states of economy. Now, these are the recessions, boom, normal, stagnated, and recovery. Now, these are the possible state of economy. It can be recession period, it can be a boom period, it can be a normal period, it can be a stagnated period or recovery period. Now, if you really apply this to Sri Lankan situation, can you see nowadays we are in a recovery type of a form. So that is the state of economy today in Sri Lanka. So before the COVID-19, we had a normal situation, but kind of another 1 year or 2 years back, about 1 year back, we had a recession. So likewise, the state of economy can change time to time. Right. Now we will see the particular question. Now the probability distribution is given. So that means the recession can happen at a 10% probability. 0.1 is 10% probability. So a boom can happen at a 20% probability. Normal can happen, that is also at a 20% probability. Stagnated can happen at a 10% probability, and recovery state can happen with a 40% of probability. So therefore, in this particular economy, the most possible state would be recovery state. Right. Now, first of all, what we need to do is we need to get the expected value calculated. In order to do that, what we need to do? We need to multiply the probability with each return, and you have to get the total. So therefore, when you want to do this question, so you need to construct a worksheet, and that worksheet will give you the necessary inputs. I will show it on the board. Now you just see the worksheet I have just created here. So you all can have a worksheet like this. The probability, one column, X return, one column, Y return, another column. Then you need to have some other columns added. P into X, P into Y. P is the probability into return. Now, when you have a column P into X, that gives the total of that. It will give you the expected value for X. When you get the total for this column, you get the expected value for Y. Then when you have the expected value for X and expected value for Y, you will have these columns, P into X minus EX. For that, what we do normally, we can have the covariance by covariance by getting these things multiplied. You can say it is so the third column will be P into X minus EX into Y minus E1. So these then. Then in order to get the sigmas calculated, we can have this also. So if you just do this worksheet, then you are in a position to get the values for the question. The answers for the question. Right. Now these things I have put on the worksheet, and part A is what is the expected covariance of Shannon's and Yaris returns for the next year. Covariance. Now that is the first thing to be calculated. The covariance has to be calculated. So in order to calculate the covariance, we have to get expected value really. So in order to get the expected value calculated, we need to do the multiplication of the probability column and the return column of Shannon, and probability column and the return column of Yaris. By doing that and adding the things, you get the expected value for Shannon and Yaris. So I think as the first exercise, you do the calculation and get the value for expected value of return of X and expected value of return of Y. Can you do that now? Now make sure that you apply these minuses also. There are minus values also. So therefore, I don't know. Here you get minus 1.2. Six, 4, minus 0.7. Yes. 12.1 and 18 would be the correct answer. 12.1 and 18. Yes, correct. 12.1 and 18. Now you know the expected values. So here also I can do that. The worksheet. 0.1 into 30, that is minus 3. 0.2 into 35, 7. 0.2 into 40, 8. 0.1 into minus 20, that would be minus 2. And 0.4 into 20 is 8. 16, 23, 20 minus 2 is 80. Right, now we all got expected value for y, x and expected value for y. Expected value of x is 12.1, expected value for y is 80. Now then, what we need to do is, we need to have a calculation here. P into x minus ex, y minus ey. So just do the calculation here. So there you get 0.1 into minus 12 minus 12.1 into minus 30 minus 80. This is the first term. The second term would be 0.2 into 30 minus 12.1 into 35 minus 80. Then you get 0.2 into 20 minus 12.1 into 40 minus 80. Then you get 0.1 into minus 20 minus 12.1 into 0.1 into minus 7 minus 12.1 into minus 20 minus 80. Then you get 0.4 into 10 minus 12.1, 20 minus 80. Now, these multiplications, if you get and added up, you will get the covariance between x and y. Covariance between x and y. Just look at it again. Now you have the probability column, that is 0.1 into minus 12 minus 12.1 into minus 30 minus 80. The second one, 0.2 into 30 minus 12.1 into 35 minus 80. The third one, 0.2 into 20 minus 12.1 into 40 minus 80. Fourth one, 0.1 into minus 7 minus 12.1 into minus 20 minus 80. Last one, that is 5, 0.4 into 10 minus 12.1 into 20 minus 80. Now when you do the calculations and get the total will be the covariance xy. Anyone who got covariance xy? What you need to do now is you need to get this column calculated and add it up. The answer 282.2 is correct. 282.2 is correct. That is the covariance between X and Y. And I have just done the worksheet. As per the worksheet, you got the values. The first value would be 115.68, then 60.86, 34.76, 72.58, minus 1.68, and it comes to 282.20. Right. Now, on the next level, what we need to do is we need to get the squares of these things here. E into square of that. Now, you get the first point where minus 12 minus 12.1, that is 24.1. 24.1 squared into 0.1. Right, you can just now, then you can complete these columns also. P into x minus ex square. Then you have P into y minus ey square. The total of those columns will give you the variance of x and variance of y. But in the question, I don't know what they have asked for. Now, the first part is what is the expected covariance of Shannon's and Yaris returns for the next year. So that we have already calculated, that is 282.2. Then they ask, determine whether the above returns have a significant relationship with each other. Now, in order to do that, what we are going to do? Now, the second question, second part. Determine whether the above returns have a significant relationship with each other. So in order to check that, what are we going to do? Now we have done the covariance. Now if you can divide it by the standard deviation of x and standard deviation of y, then you will get rho. Rho can be determined. So if the rho is the value of the rho can give us a certain indication with regard to the relationship. Right now, then our next task will be to determine the standard deviation of x and standard deviation of y. Now, in order to do that, what are we going to do? Yes. Now we have another two columns. So those two columns, through those two columns, we are in a position to get the standard deviation of x and standard deviation of y. Right. Now, what you need to do is now you need to get the standard deviation of x calculated and standard deviation of y calculated. Then you have the covariance x and y, xy, and it should be divided by the standard deviation of x and standard deviation of y. Then the value is, we call that value the rho xy. That has to be found. That has to be found. Of course, now anyway, what we can do is the columns given, it is you can just look at it, and I have just given guidance only. So you do the calculations, and what you need to do is you need to have this type of columns. The first column is the probability column. Second column is the x returns column, y return column. Third one, the fourth one is the probability multiplied with returns of x. Then next column, probability multiplied with returns of y. Then you have another column that is p into x minus ex into y minus ey. So that is a very important column. And then you get p into x minus ex squared column. Then p into y minus ey squared column. So that is what we have to do. So anyway, okay, now have you been able to calculate the standard deviation of x and standard deviation of y? But there's nothing called covariance of y. Of course, now when you want to say anything about covariance, it should be something, there should be a couple of things. Covariance of x and y, we have to say. But there's nothing called covariance of x, y. I think made a mistake. So it should be, I don't know whether you have done the variance or whatever. So when you get the p into x minus ex squared column total, that is the column I have put in the last, before the last one. So that column actually, you have to get those values. Yes. But I think there's a small mistake now. What you do, this Hasini, you got the value variance for x as 172.89. That is correct. 172.89 is correct. Just check the other one. I think it has a small mistake. Anyway, I don't know whether I have made a mistake. So the variance should be 531. Yes, correct. Variance of y should be 539, 531. That is correct. Then when you got the variance, in order to get the standard deviation, you need to get the square root of that. So therefore, you can see the standard deviation of x is 13.15. That is correct. SKNR Super Singh has given that answer. X is equal to 13.15. That is the sigma x or standard deviation of x, 13.15, and the other one, standard deviation of y is 23.04. That is correct. So then we need to get the correlation by dividing the covariance of covariance. We got covariance as 282.2. That has to be divided by 13.15 into 23.04. Then you get the answer as 0.9314. Anyway, to the nearest two decimal, this is correct. The correlation would be 0.93. It's okay. So now when you get the correlation value as 0.93, then you have to analyze and just give a certain decision. So what is the meaning of getting correlation of 0.93? It's a positive value. Now you got 282.20 as a positive value, and even invariably the sigma x and sigma y should be positive, but since you got a covariance positive value, so therefore correlation also you get a positive value of 0.93. So what does that mean? Now if the correlation coefficient is very close to 1, that means there's a significant relationship between x and y. Between x and y's return, there's a significant relationship. That is what you mean by having a correlation of 0.93. In other words, it is a correlation of 93%. 93%. So since you have a 93% correlation, which means it's a rather highly significant relationship. It is very close to 100%. So 93 is a close one. So therefore, the relationship is very positive. Very positive. So that is the answer for the part B. Determine whether the above returns have a significant relationship with each other. So then you, while getting the answer, you can say, since the correlation coefficient is 0.93 to 1 or something, 9314. So since it is 9314, we can say the relationship between x and y's return is very significant because it is very close to 100%. Right. Then part C. If a portfolio is created with 40% of Shannon stock and 60% of Yari stock, what is the total risk of that portfolio? So this is another subject area which gives an idea about the portfolio standard deviation. Now you got the standard deviation of x and y. We have already calculated that. Then we need to get the portfolio standard deviation by using the standard deviations of x and y together with their weights. And we know not only the standard deviations, we know the correlation coefficient also. Therefore, we are now in a position to not only the correlation coefficient, we got the covariance also. Since we know the covariance, we can do it. We can get the portfolio risk also calculated. Just do it. Right, the last one, last part. So how are we going to do that? Now they asked in the question it is asked to get the variance or the portfolio risk of a portfolio which is constructed with 40% of X and 60% of Y. 40% of X and 60% of Y. Now that means the weights are given. That is weight number 1, X. X or W1 is 40%, that is 0.4. And W2 is 0.6. Then first of all you get W1 squared sigma 1 squared, that is 0.4 squared into sigma x squared. Sigma x squared is 172.89 plus 0.6 squared into sigma y squared, that is 531 plus 2W1 W2 2W1 W2 2 into 0.4 into 0.6 into covariance xy. Covariance xy we have already determined, that is 282.20. So then you can put there the last term 2 into 0.4 into 0.6 into 282.2. And when you work it out, you get the variance of the portfolio. What is the value? Variance of the portfolio. Yes, I will do the calculation for this on the board. Sigma p squared is equal to wx squared sigma x squared plus wy squared sigma y squared plus 2wx wy covariance squared. Now this is the formula. Is the formula. So wx squared is 0.4 squared. Sigma x squared is 172.89 plus wy squared is 0.6 squared. Sigma y squared is 531 plus 2.4 into 0.6 into 282.2. Now this gives the portfolio variance. Now when you get the portfolio variance calculated, yes, I have just written on the board here. And have you got the total for that? Now we have already got the squares of these things and just substituting here. Yes, 354.27 would be the total of portfolio's variance. And when you get the portfolio variance, you are in a position to get portfolio standard deviation by getting the square root of it. The square root will come to 18.82%. Yes, good. Now you have done the the total one. Now, when this question is asked, what is the total risk of that portfolio? So it should not be the variance, right? When you talk in terms of risk, that is referring to the standard deviation. So therefore, if someone put it as 354 something as the variance, that person would not get the full marks. Full marks only can be given to the standard deviation. So standard deviation is 18.82. Now you just see the distribution of marks also. The last part carries more marks. It carries 8 marks. Earlier parts carry only 6 marks each. Now you see the point there. The formula is a very important formula. And you need to by heart that. Or you need to remember. And there can be a situation where you get a 3-asset portfolio, and to calculate the portfolio variance or portfolio risk, then you need to get that formula also. As an extension, I will just give you the way it can be done. I will put it on the board after erasing all these things, and I will put that also, because I think that you need to have some idea about calculating portfolio variance or portfolio risk for portfolios with more than 2 assets. Even the subject syllabus will have to cover the N asset portfolios. N asset portfolios. So N means any number of assets in a portfolio, you should be in a position to calculate the portfolio variance and portfolio risk. Now, say, for example, if you have 4 assets in the portfolio, which has how many covariance terms? 6 covariance terms. 6 covariance terms. When you have 5 assets in the portfolio, you have how much? 10 covariance terms. When you have 6 assets in the portfolio, you will have 15 covariance terms. So likewise, you need to know how many covariance terms are there. But with the computer and Excel sheets or whatever, this calculation would not be a very cumbersome one, even though the number of assets increase. But for an examination, you should not expect a certain number of assets as 5, 10 or something like that, but it can be sometimes at most 3 assets. At most 3 assets for an examination. Otherwise, now you have to use your Excel sheets or whatever, no? So therefore, such things may not be given. Now, I think you all have an idea about the formula here. What I want to tell you is just if you get another sum with 3 assets, so you should be in a position to calculate such portfolio risk also. Oh, you just see the point here. Even though the calculations are a little cumbersome, this is straightforward because there's no confusion here. So you do the needful on a worksheet, and that worksheet will give you the maximum benefit. And make sure that you construct the worksheet in a manner where you can get the things in a very clear way. And for the whole sum, the worksheet gives the information. Right. Then we will go to the next question. Now that is question number 3. The Serendip company's earnings and dividends have been growing at a rate of 7% during the past several years. And this rate of growth is expected to continue in the foreseeable future. If Serendip's current dividend per share is $3, what is its current price? Assume the following two-factor model applies and that beta 1 and beta 2 for the Serendip company are 0.6 and 1.4 respectively. Now, this is a rather little, little challenging thing where you have a equation given, but that equation gives you some necessary data for the calculation. Now, just see, if you look at the initial part of it and get the information there, dividend growth rate is given. And it will continue. And so therefore, now you are okay with the dividend growth rate, that is G. G is equal to 7%. And you have another part of it, and it says current dividend per share is also given. It is 3, that is D0. What is missing here? In order to get the current price calculated, you can make use of the formula. The formula says P0 is equal to D0 into 1 plus G divided by K minus G. K is not given. K is the return, expected return. But there's an equation given in order to calculate the expected return. Now it's a matter of calculating the expected return by using beta 1 and beta 2 given in the sum. Beta 1 is given as 0.6, beta 2 is given as 1.4. So you have the equation also. So then it is a matter of calculating. So I think you can calculate that. Anyway, we will have a break now, and we will start by 10:35. While having the break, you can just go through the sum and see how you can calculate ER and then get in the stock value of Serendip company. We can start the session now. As it is, I just gave you a question now, question number 3. Have you been able to calculate the stock value for that? Right. Now, as it is, the Serendip company's earnings and dividends have been growing at a rate of 7% during the past several years, and this rate of growth is expected to continue in the foreseeable future. Now, that gives us as an information, that is the rate of growth of dividends, that is 7%. G is equal to 7%. Then current dividend per share is $3, that is D0 is $3. And current price is, they ask the current price. And there's a two-factor model given. That is in order to calculate the rate of return. Now I will just work it out on the board. Right. Has anyone calculated the rate of return? Yes. Anyone calculate the rate of return? Now just check. Our two-factor model is ER is equal to 5% plus 2% into beta 1 plus 6% into beta 2. And in the question paper, beta 1 and beta 2 given. Beta 1 is 0.6 and beta 2 is 1.4. Now we substitute for those values and you get 5% plus 2% into 0.6 plus 6% into 1.4, which comes to 5% plus 0.6 into 2 is 1.2%. 1.4 into 6 is 8.4%. Now altogether it will be 14.6. That is the rate of return, 14.6. I think all can realize that this is the rate of return, and using the given data, you are in a position to calculate the rate of return. So that is K. In our formula, we denote it as K. Now, the first part is to calculate the price of the stock surrounding. Now, what are the information available? Now, G is equal to 7. G is equal to 7. G is equal to 7%. K is equal to 14.6%. D0 is equal to 3. Therefore, D0 is equal to D0 1 plus G divided by K minus D. That is 3 into 1 plus 0.07 divided by 14.6, that is 0.146 minus 0.07. That is 0.076. 3 into 1.07 divided by 0.076. Now, right. Now look at the formula here. Formula comes as P0 is equal to D0 into 1 plus T divided by K minus D. And I have just substituted the values. D0 is 3 into 1 plus 0.07, that is 7%, divided by 0.146 minus 0.07. And in the denominator, it comes to 0.076. And in the numerator, it is 3 into 1.07. Now, when you work it out, you will get the answer, the stock value. It will be 3 into 1.07 divided by 0.076. That is 42.2368. So we can put it as 42.24. 42.24. To the nearest two decimals, we can put it as 42.24. Good. Right. Now, then what we can do is, now we can go to the next part of the sum. If Serendip company had a policy of paying dividends at a growth rate of 20%. Now the policy being changed, and together with the policy change, what happens is they wanted to pay a higher rate of dividends. Growth rate is 20%, and it would remain for further 7 years. Assuming every other factor stay unchanged, what would be the current price of Serendip stock? So that means now, till 7 years from now onwards, the growth rate would be 20%. Now you all know, now you can't just apply the one stage model, because if you try to apply that, you will get a minus value for the price. There the rate of return is 14.6 and the growth rate is 20%. So growth rate is higher than the rate of return. So therefore, if you want to apply these things into the one stage model, what will happen is, one stage model comes as B0 is equal to D0 into 1 plus D divided by K minus D. K is only 14.6, whereas D is 20. That means you get a minus value of 5.4. With that minus value of 5.4, you get a minus price on the stock. So that is not realistic. So therefore, you all know that we are now not in a position to calculate the price by using the one stage model. So now in your examination, So you have to mention this for the second part. So when you try to answer the second part, you have to say that since the growth rate changes to 20%, the one stage model will not give a realistic value for the stock. So therefore, invariably we have to follow the two-stage dividend discount model. And it says for another 7 years, the 20% growth rate would prevail. Now we need to see what we can do. So for 7 years. So therefore, from now onwards, we have to check the for next 7 years, what would be the cash flow? It would be dividend cash flow. This year's dividend is only 3. So next year, what is the next year dividend? 3 into 1 plus G. And that dividend has to be discounted for today's rate, and that has to be divided by 1 plus 0.146. Now that has to be done. The future 7 years cash flows to be present value and to be added. And that then on the 7th year, we have to see what will happen. From 7th year onward, what will happen? Again, the growth rate will come down to 7%. So that is the theory. So then how can you try to arrive at the stock price of Serendip stock with the new situation? Now for 7 years, you have to calculate the present value of dividend cash flows. In the first year, you have 3 into 1 plus G, that is 3 into 1.07 divided by 1.146 plus 3 into 1.07 to the power 2 divided by 1.146 to the power 2 plus 3 into 1.07 to the power 3 divided by 1.146 to the power 3. Likewise, you have to put it up to 7. So last figure on that of that cash flow would be 1.07 to the power not 07, 1.2. Sorry, 1.2 because the dividend growth rate is 20%. No, so therefore 3 into 1.2 is the first year's dividend. 3 into 1.2 divided by 1.146. That is the first one. Second one would be 3 into 1.2 to the power 2 divided by 1.146 to the power 2 plus 3 into 1.2 to the power 3 divided by 1.146 to the power 3. So likewise, it goes up to 7. And the seventh one would be 3 into 1.2 to the power 7 divided by 1.146 to the power 7. Now at the 7th year, now we try to calculate the price at the 7th year. 7th year price. So how are we going to calculate the 7th year price? Since from 7th year onwards, the dividend growth would be only 7% again. So what will happen? Then you can say we can use the one stage model to calculate the price after 7 years time. So how are we going to calculate that? So at that point, the dividend amount you have to calculate, and that amount will be again grown by only 1 plus 0.07. So what is the dividend at that point? 3 into 1.2 to the power 7 would be the dividend at that time. So that has to be multiplied with 1.07 and to be divided by k minus g. K is 0.146. G is again, it would be 0.07. And it has to be present value. And for that, you need to divided by 1.146 to the power 7. So that would be the expression or calculation for getting the stock value when the growth rate of dividends 20% for a 7-year period. So I will write down the steps to calculate the stock price when the growth rate increases to 20% for 7 years. I think you all can see how you can do it, and while you try yourself, I will put it on the board, and then I will check whether some of you have arrived at the answer before my calculations. Yes. So you need to write these things. Since the dividend growth becomes 20%, we should use two-stage model to calculate stock price. P is equal to 3 into 1.2 1.146. Into 1.2 to the power 2 divided by 1.146 to the power 2. 3 into 1.2 into to the power 3, 1.146 to the power 3. 3 into 1.2 to the power 4, 1.146 to the power 4. 3 into 1.2 to the power 5, 1.146 to the power 5. 3 into 1.2 to the power 6, 1.146 to the power 6. 3 into 1.2 to the power 7, 1.146 to the power 7 plus. Now, these are the 7 cash flows which would be recovered during the next 7 years. Dividend cash flows. And those dividend cash flows to be present value or discounted at a rate of 14.6. That is what we did here. Then, on the 7th year, we have to imagine that the stock will be sold. And if it is sold at that point, from 7th year point onwards, the dividend growth rate again come down to 7% as per the sum. So, if you apply the one-stage model at that point, the first thing would be D0 into 1 plus D. So, therefore, D0 is 3 into 1.2 to the power 7. And in again, it has to be multiplied with 1.07 because 7% is the growth rate again. 3 into 1.2 to the power 7 into 1.07 divided by k minus g. K is 0.146, g is 0.07. Now this is the value after 7 years, the price, but it has to be present value. In order to do the present value calculation, what we need to do is 1.146 to the power 7. Now this, if you simplify these things, you will get the stock value. You will get the stock value. Yes. Anything wrong with that? P is equal to anyway. Now this calculation really, you have to get the 7. Yeah. Anyway, even though the clearness is not there, what you can do is, now I have just given the steps. What we need to do is, you have to get the 7-year cash flows calculated, present values. The first year cash flow would be, since the growth rate is 20%, the first year dividend cash flow would be 3 into 1.2, and to be present value, it has to be divided by 1.146. Plus, in the second year, you will get 3 into 1.2 to the power 2, and it has to be present valued by dividing 1.146 to the power 2. Likewise, it has to be done up to the 7th year. On the 7th year itself, what will happen is, we assume that the stock would be sold at that point, and from that point onwards, the dividend growth rate again comes down to 7%. Then we can make use of one-stage model, and as per the one-stage model, the numerator would be 3 into 1.2 to the power 7, that is the dividend D0, and it has to be multiplied with 1 plus G. G would be 0.07, 1.07. So then the numerator would be 3 into 1.2 to the power 7 into 1.07. And it has to be divided by K minus G. K is 0.146, minus G is minus 0.07. So then it has to be present valued. In order to get the present value, you need to divide it by 1.146 to the power 7. So if you simplify these expressions, you will get the stock value. We will see. Even though that is not very clear, so you can just gather what it is since I read the things. Anyway, you can make use of these things and just do the calculations, and someone has come up with the calculations. It is 83.64. Anyway, I will check and tell you. Yeah, I think your answer is correct. There may be a small decimal difference, but that would not be a matter. 8363. I got it as 8363, but anyway, I did it for only two decimals, and someone has done it up to the 4 decimals, and later on only they just put it to 2 decimals. Anyway, this answer is correct, 8365. Even if it comes as 63, that's okay. Right. Now I think you got the real point there. So no need of by-hearting these formulas. So only thing is now you can do this way, and then you can get the real answer without any issue. Right. Now you can see with the high growth of dividends, you can expect a higher price, because earlier the price was not that high. It was only it was only 42 to 23. But with the high growth of dividends, the price has gone up to 83.65. So that you can understand. So anyway, now this particular sum for the calculation of price at the higher dividend growth rate carries a high amount of marks, because it carries 12 marks out of 20. So then you can see the weightage given to this type of a calculation. Right. Now the next one, we will go to the question number 4. What is the market price of a bond that is paying 8% annual coupon in semi-annual payments if its YTM is 10% and it has 3 years and 10 months from its purchase date until maturity? Assume the face value of the bond as rupees 100 million. Now, how are we going to do it? Since the coupon payments are made on coupon dates, but the purchase was made on a not on a coupon date, but in between two coupon payment dates, 3 years and 10 months. Because when you say 10 months, another 2 months to be gone in order to get the next payment, next coupon payment, and earlier coupon payment has made and it has gone 4 months being passed. So that is the situation. And it has 3 years and 10 months from its purchase date until maturity. Now, since it is 3 years, how many coupon dates are there? How many coupon payments are there for 3 years? 3 years you will have 6, since it is semi-annually paid. And another 10 months also there, so that we'll have another one. So 7, another 7 coupon dates. Yeah. So you can really draw a line like. Right. Now you need to draw a line and just get an understanding about how the payments are made and what type of coupon payments are made and all that. So just look at this line. Now this is 3 years and 10 months. So therefore, now this is the point where the purchase is made, and this is the last coupon payment. And from last coupon date, 2 months been passed, because from this point onwards, there will be 3 years and 10 months. Now this is 4 months and 1, 2, 3, 4, 5, 6. Here 3 years and 3 years and 6 months, and here 3 years and 10 months. So that is how it is been just drawn. Anyway, I will just do it on another way. If I written right here, I think it would be okay, no? Now, this is the last coupon payment date, and this is the purchase date. From purchase date to the maturity level, there will be 3 years and 10 months. So this particular thing, another next coupon payment date, there will be 4 months. From here onwards, altogether 3 years. Sorry, 3.5 years. 1, 2, 3, 4, 5, 6, 7. 3.5 years. So you get the point. Now what we can do is, we can just calculate the present value at this point, or the price at this point. So you have the values, and as it is, the given coupon rates and YTMs are given in the sum. Just to check. %8 annual coupon. Since the 100 million is its face value, coupon payment is 8% and its annual rate, and it will be 8. It will be 8 the annual payment, but since the payment is made semi-annually, so therefore semi-annual payment is 4. Semi-annual payment is 4. So for that payment you will get every time up to this. Now there will be payments of 4 at these points, and at the last point you will get 104. At the last point you will get 104, and we need to discount this at half-year rates or half-year periods. You need to discount that half-year periods. So therefore, we can do it this way. Now, since it is half year period we are talking about, we do the discounting considering the half year periods. Since the half year periods are considered, YTM is 10%. So therefore, discounting has to be done at 5%. At 5%. So therefore, I will put the discounting factors this way. Now, I will put X here at point X, the price of the bond, equal to 4 over 1.05 plus 4 over 1.05 to the power 2 plus 4 over 1.05 to the power 3 4 over 1.05 to the power 4, 4 over 1.05 to the power 5, 4 over 1.05 to the power 6. Then last one, 104 over 1.05 to the power 7. Now this will be the point X, at the point X, the price. But you have to add the coupon payment at that point also, since it is on the dot. 1, 2, 3, 4, 5, 6. Yeah, the correct answer is correct, but what you need to do is this 94.21 is the price without the uh, coupon payment on the particular point. So that coupon payment also to be added. Then the price is okay for this point, but what we need to do is we need to calculate the price at the purchase date. In order to calculate the price at the purchase date, you need to get the total cash flows at this point. So that is 98.21. 98.21. So when you take 98.21 and it has to be discounted for 4 months, because our purchase date is 4 months away from that. 4 months away from that. That is, if you take the half year as a period, so 4 months is 2/3 of that period. So what we can do is we can discount it 98.21 divided by 1 plus 1.05 2/3. So that will give you the purchase price. That will give you the purchase price. Because for this point, when you calculate the price, we have not taken the particular payment on this day. On this date, payment is due. So that payment is 4. So therefore, when you calculate the price at this point, that is 94.21, and that is the present value. But you have to add the other payment of 4 also. So then it will be 98.21. So 98.21 has to be discounted at this rate. The answer will be 95.07. Correct. 95.07, yes. So that is the purchase price or dirty price. Yes, correct. So you can just calculate the approximate accrued interest also, because what do you mean by the accrued interest? So this particular one, the interest is really entitled only after purchasing it, and that earlier entitlement is really for the earlier person. So therefore, that is 2 divided by 6. So that means 1/3 of the coupon period interest will be for the other party. So that is what you call the accrued interest. So that has to be calculated by multiplying 4 by 1/3. So 4/3 would be the accrued interest. So you can just look at the accrued interest also. That is 4 divided by 3. That would be the accrued interest. There are the accrued interest also included. Right. I think there's no big issue here. Only thing is you have to identify the type, the point on which the payment is made or purchased, and how long from that point to the earlier payment date and next payment date. So that is what you need to understand. And when you do the discounting and all, there you have to identify clearly the time periods. We will go to the question number 5. Part A. State the assumptions related to modified duration and its importance as a measure of interest rate sensitivity. Now, assumptions in the sense, when we talk in terms of modified duration, we just do it in order to have an idea about the interest rate sensitivity. Yeah, what you can do is, now you really check with a small change in the interest rate, what would be the change in price of a bond. So the rate of change would be the modified duration. And in the modified duration calculation, we assume the interest rate change, since it is very low, we assume the particular curve as a straight line. So that is one assumption. And therefore, when you put in terms of modified duration, the assumptions are basically change of interest rate is very minimum. Since the rate of interest rate change is minimum, the the curve between the two prices would be assumed as a straight line. So these are the assumptions. Then importance is, it is a measure of interest rate sensitivity where an idea can be taken with regard to the price change, relevant price change due to the change of interest rates in the market. So that is the importance of modified duration. So we will go to the next part of it. The bank invested in a treasury bond with a face value of rupees 100 million, paying an annual coupon of 10% per annum. Bond remaining maturity is 5 years and the YTM is 12%. Calculate the maturity duration of the bond. Now, the payments are being annually, made annually. So when you say annual coupon of 10%, the meaning is coupons paid annually. But annual rate of 10% paid semi-annually is another part. But when you say paying an annual coupon of 10%, means coupon payment is done annually. So for that, we can just get the calculate the macular duration by using that. Now, in the case of macular duration calculation, you have two methods. One is the continuous compounded method, but if you go by the continuous compounding method, your calculation will be little different. But if it is not mentioned, so you can just do it on normal way. All right, here it is specifically said interest calculations to be made on continuously compounded basis. So therefore, you don't have any other option. You have to do it on a continuous compounded basis. So that is what it has been said. So then we have to just calculate the things on the basis of continuous compounding basis. Now you just see a bank invested in a treasury bond with a face value of rupees 100 million, paying an annual coupon of 10%. So annual coupon of 10% means a 10 million coupon will be paid. So you have 5 years remaining maturity and YTM is 12%. So how are we going to calculate the macular duration? So what we need to do is we need to get the times and relevant cash flows. And it has to be multiplied with the times. So then first of all, we calculate the present value of cash flows. So then we need to have a worksheet. We need to have a worksheet. You can say time, cash flow, present value of cash flow, weight, time into weight. Now these will be the columns. So we can have 1, 2, 3, 4, 5. Cash flow is say 10. So present value we can say 10 into e to the power minus 1 into 12%. Right. We can just see now. Now the time periods are 1, 2, 3, 4, and 5, the years. Then you have the cash flows, just cash flows as 10, because the coupon rate is 10% and 100 million is the value. So 10 million would be the coupon amount. So every year you get 10 million. Last year you get the maturity proceed and the coupon, that is 110. So in order to get the present value calculated, so you need to multiply the cash flow with e to the power minus n into the YTM. N is the number of years, that is 1, and to be minus e to the power minus 1 into 0.12. So that comes to 8.869. So when you get the second year's cash flow, where 10 into e to the power minus 4 into point, yeah.
Sir, how to apply e to the power in 100 ms calculator?
In order to get right. So what you can do is you can just check the particular EX button. Do you see the EX button there? Can you see the EX button at FX calculator? Or
yes, sir.
sometimes, yeah,
On
it
the
can be, yeah. You have a button called LN.
LN,
Is
yeah.
there a button LN?
Yeah.
So what
Yeah.
you can do is now EX is on top of that. I think on the LN button, just up on that, you get EX. So what you have to do is in order to get that function, you need to press another button, second function button or something. So then you get the EX.
Alpha button to be pressed, no?
Pardon?
Alpha button.
Yeah. Because there are second functions and all. No. So that is now in your calculator. What happens is in order to give two functions to one button, they did that because now you just have you found the button LN?
Yes,
There's a
sir.
button called LN, right? So on the on top of that, I mean, just above that, you can see EX.
Yes.
That is in yellow color or green color?
Yellow color.
Yellow color, right? So there's a yellow button. When you press yellow button and press LN, then you get EX.
Okay, sir.
There's a
Okay.
yellow color button, right?
Yeah. Got
When
it.
you press the yellow color button and press LN, you get the EX function. That is how you can get it. I think you can find it.
Yes, sir. Thank you.
Right. So the second year you get 10 into e to the power minus 2 into 0.12, that comes to 7.866. And the third year you get e to the power minus 3 into 0.12 and into 10, that is 6.977. And fourth year you get e to the power minus 4 into 0.12 into 10, that is 6.188. And last one, now it contains not only the coupon payment but the maturity proceeds also. So therefore, you would get 110 million cash flow, and that has to be multiplied with the e to the power minus 5 into 0.12. That is, the calculation will come at 60.369. And when you add it up, you get 90.269. And when you want to get the rate calculated, what you need to do is you need to get different cash present value of cash flows divided by the total value. So the first rate you get by dividing 8.869 by 90.269, that comes to 0.0983. Then you get next one, that is 7.866 divided by 90.269 comes to 0.0871. I just did it for the nearest third decimal. And the third one, that is 6.977 divided by 90.269, that comes to 0.0773. And the fourth one, that is 6.188 divided by 90.269 comes to 0.0686. And the last one, 60.369 divided by 90.269 comes to 0.6687. And if you take the total up, and that comes to 1. So then the next part would be to calculate the time into rate column. Now what you can do is the time column value has to be multiplied with the weight column value. So then you can fill up that column. So here you get 0.0983. Here you get 2 into 0.0871. That is 0.1742. And 3 into 0.0773, that is 0.2319. Then you get 4 into 0.0686, that is 0.2744. And the last one, 5 into 0.6687, that is 3.3435. 3.3435. Now, when you get the total of this, you get the duration 0.0983 plus 0.1742 plus 0.2319 plus 0.2744 plus 3.3435. 4.1223. This is the maturity duration. This is the macular duration. Right. Then what we need to do is we need to see state the assumption rate to modify duration, then bank investor duration of the bond. State the mathematical equation depicting the price change of a bond in relation to market interest rate changes using the standard notations. So, can you remember these things? I think I just gave it in a presentation. Now, when you answer this question, the third part of it, the mathematical equation depicting the price change of a bond in relation to market interest rate changes using the standard notation. So how can we put it? I will put it on the board. Right. Now this equation I put on the board. Now it says delta P is equal to minus D into delta Y into P plus half into delta Y squared into convexity C. Now just look at it, and you need to identify the notations. Delta P is the change in price. Delta P is the change in price. Then D is the duration, minus D is the duration into delta Y is the change in interest rate into P. P is the price. Then again, you need to multiply here also with price. Then you have half into delta Y squared. That is the yield change squared into convexity into P. P is the price. Now already we have calculated the price of this. Now this is the equation for the price change for a relevant interest rate change. Now if you go to the next part, you will find that there's a 350 basis point difference in the interest rate, and you need to calculate the price change according to that change in interest rate of 350 basis points. Now, as it is, you know, in a duration calculation, if you have a high change of interest rate, now basically the high means when it is more than 150 basis points, we consider it as a high rate of change. So there you have to use the full equation. And in order to calculate the change in price, you need to get the convexity also calculated. You need to do the convexity calculator. Now there what you do? You need to have another column called time squared column. Time squared into weight, the total will give you the convexity. That is the convexity of a bond, right? C, that is C. So in order to get the convexity calculated, you need to have another column, time squared into weight. So we can have that also. Time squared into weight. I think the first line will be the same because time squared of 1 is already 1. Then when you have 2, yeah, you instead of 2 you have to put 4 there. Then 4 into 0.1742. That is 0.6968. Then you have 3 is what is 3 square is 9. 9 into 0.2319. That is 2.0871. Then you have next one, that is 4. Time is 4 and time squared is 16 into 0.2744. That is 4.3904. And the last one, time squared is 25 into 0.6687. Sorry. I have made a mistake here. So just to you have to multiply with the weight. So time squared is 4 for the second one. I made a mistake there. Into 0.0871. That is 0.3484. And the third one, time squared is 9. 9 into 0.0773. That is 0.6957. Then you have the fourth one, that is the time squared is 16 into 0.0686. That is 1.0976. The last one, that is time is 5 and squared is 25 into 0.6687. That is 16.7175. Now we get the total. The answer is 18.9575. Now, this is the answer for convexity. So you can just put somewhere duration or D is equal to 4.1223. C is equal to 18.9575. Right. So now you can just check that, and we have already calculated the duration and as well the convexity. And since we have the equation here, we are in a position to do the calculation for this interest rate change and the respective price change. So you just get the question here. Now, only state in the mathematical equation is the part C, right? So that's a very easy question, and if you know the mathematical equation, then you get 5 marks. Then you have to, now after writing the equation, you need to just explain what it is. So you can say delta P is the change in price, D is the duration, delta Y is the change in yield, then P is the price, and C is the convexity. So that way you can just mention about these things. If you don't mention that, then you don't get the 5 marks. You might get only 2 marks or so. So if you go to D, part D, there's a 350 basis point increase. Now, even though here no just mentioning of calculation of the convexity, but since the interest rate change is 350 basis points, invariably you have to get the convexity also into the equation. That has not been given in the sum. The candidate has to decide on that. That is why here it says 350 basis point increase. Now that's a substantial increase. For a substantial increase, without convexity adjustment, the answer is not correct. So new price of the bond would be asked. So there what we need to do is, now we have already calculated the convexity and the duration. So you can do the needful there. And 350 basis points means in percentage form it is 3.5%. So and it can be taken as 0.035. 0.035. I will put the numbers and just show you the way it is to be calculated. Right. Now using this equation, you can say delta P is equal to minus D is minus 4.1223 into delta Y is 0.035 into P is 90.269. Then plus half into delta Y is 0.035 squared into C. C is 18.9575 into price 90.269. If you simplify this, then you will get the change in price, delta P. Now this is the way it has to be done. Delta P is equal to minus 4.1223, that is the duration, into 0.035, that is the 350 basis point means 3.5%, and that in decimal form it is 0.035 into the price 90.269, and into plus half into delta y squared, that is 0.035 squared into convexity, that is 18.9575 into P is 90.269. When you simplify that, you will get the delta P, the change in price. There's a price change of 11.9758. So that's a big change in price. So you can say million, it is changed by 11 or very close to 12 million. There's a price change of 12 million in the bond. And just check that. Right. So then the new price would be 90.269 minus 11.9758. So you will get the new price by that. Okay. So I think I have tried my best to put you through the questions, and I think you all can do it on your own. And we,
Sir?
yeah.
So in this question, it is not clearly mentioned semi-annual coupon payment kind of a thing. So at that time, what will we do for resolve this?
No. You just go through the question and see. I will show you. I will show you. Right. Now here it says, a bank invested in a treasury bond with a face value of 100 million, paying an annual coupon of 10% per annum. Annual coupon, paying an annual. Now, if it is the semi-annual thing, they might say paying semi-annual coupons of 10% per annum rate. Annual
So
coupon.
in your previous lesson, you told that if it is not So you can consider that as semi-annual kind of a thing.
Yeah.
So that's
Anyway,
what I'm
the thing
asking.
is now here it is clearly mentioned that it is annual. No, if they say paying coupons at 10% per annum rate, if that is the way, then you could have taken it as semi-annual, right? But here it is clearly mentioned that is in annual coupon. It says annual coupon. So then there's nothing vague here. It is clearly mentioned that it is paid annually. That is mentioned. So therefore you have to take it as annual. But as it is now, your problem is this. Now, if I say 100 million paying coupons at 10% per annum, then it is semi-annual, if that is the case. Right? Here it is clearly mentioned that it is paid annually. Now you can just go by the words. Huh? Paying an annual coupon of. Paying an annual coupon of. Annual, what was it now? Just annual? That is, every year it is to be paid. But if it is said paying a coupon of 10% per annum, without mentioning annual or semi-annual, then you have to take it as semi-annual. Right? Okay. And I think this particular sum, I think no mentioning of the calculation of convexity, but you should calculate the convexity, otherwise you would get a wrong answer. So that's another thing you need to understand here. And I think we have done complete four problems, and it really together with the necessary explanations. And if you find that you have not got it clear or whatever, so then you can just see how you can really clear the doubts or whatever. And since your course is now going to be completed very soon, so you have to be very much competent with what you have learned, right? And at the same time, I just give you a certain opportunity to ask me some questions over the phone. I can give my phone number to you, my hand phone number, that is 077 298 1112. 077 298 1112. If you come across any issue with regard to these questions and all that, you can give me a call and clarify that. That is an opportunity given to my students. So you will be in a position to do that. Right. Anyway, for your active participation, I thank all of you very much. And we will meet again at the next time, another set of questions. And in the meantime, what you can do is you can just go through the other questions and find out, if you find out any type of a issue or any type of a problem, so you can come back to me and ask the question, or even next time you can clarify the things at the class. Right. Thank you very much.